Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. We'll focus on 3 points today. Pullbacks in stocks have been very hard to find since April. The S&P 500 has been incredibly strong, and Q3 specifically really bucked the seasonality trend, which is historically a pretty weak time of year. And then from a fundamental perspective, corporate earnings have been strong, but profit margins are also really high and expectations are at or near all-time highs as well. We'll discuss why that might be a good sign, even though the labor market has certainly shown some weakness as of late. Now, pullbacks in stocks have been hard to find since April. On the screen here, we have a chart of the S&P 500 index. You can see that nearly 20% drawdown in the midst or the height of tariff turmoil back in March and April. In fact, the S&P 500 bottomed on April 8th, but since then it has been on a rocket ship, up 36% through the start of October. And there haven't been very many pullbacks. On the table there on the bottom right, you see all of what I would, in quotation marks, call drawdowns during this bull market rally. And the average drawdown has only been 2.5%, and on average only lasted 4 days. For those investors that had a lot of caution or uncertainty around tariffs, or those investors that have been waiting on the sidelines to sort of buy the dip on a significant pullback, those pullbacks have been very difficult to find and have not lasted very long. I think that's why this market continues to climb that wall of worry. Now, speaking of that wall of worry, the third quarter is historically the weakest quarter of them all, and that is absolutely not what investors experienced during the Q3. So on this chart in the teal, we have the S&P 500 quarterly returns since 1928. So these are the average returns that investors experience for each one of the 3 quarters. And you can see they range between 1.4 to 2.9%. But you can see Q3 is the weakest of the 4 quarters. In fact, August and September are the two weakest months during the year. This market really bucked the trend with the S&P 500 up more than 8% during this quarter. That's on the heels of that nearly 11% rally that it experienced during the second quarter. And oh, by the way, it's getting ready to start the fourth quarter, which is historically the best quarter in the history of the market. We will see how that unfolds, but the momentum is certainly on the stock market side during the past several months. Now, one of the reasons is that corporate earnings have been really strong. It's been a major driver of this rally. One aspect of corporate earnings is going to be the profit margins, right? That's the top line revenue, subtracting all expenses, results in that net income. And you take that net income divided by revenue, and you're at your profit margin. Now, higher profit margins are good. And you can see over the past 4 quarters, the S&P 500 has been at or just above 13% profit margin. How high is that? That's near an all-time high if you look back throughout the stock market history. In fact, expectations are for it to remain relatively stable over the next couple quarters, and in Q1 of 2026, actually eclipsing up above 14% profit margin. This is good because earnings are a major driver of long-term stock market growth, number one. And number two, there's no doubt if you look at the non-farm payrolls, labor market hiring is slowing. The last 4 months, we've seen labor market non-farm payrolls below 100,000 jobs. Companies aren't hiring at the same pace that they have before, but because we have such healthy profit margins, you are unlikely to see layoffs. And if you look at the Challenger layoff data, it confirms this. Companies are not laying off people. And if you look back historically, you do not experience recessions without significant layoffs and a significant increase in the unemployment rate. So these profit margins are one statistic that supports perhaps the resiliency of that labor market over the next 6 to 12 months. Now, I want to thank everyone for watching. And this was an interesting summer story where thieves made off with a haul of rare whiskey. This was in the state of Washington a couple months ago. I believe they're still outstanding now. It was estimated at about $1 million worth. Nobody exactly knows who did it. It's been very rare. They're very rare bottles of whiskey. And there's no obviously secondary market in the US to sell these. So they've been kind of waiting and wondering how are they going to sell these? Perhaps they try to long haul them to Europe because there is a secondary market in Russia and those places to sell whiskey. Not sure of the value, but they got off with a significant, very rare whiskey from this craft brewery or distillery rather, in Washington State. But once you have the whiskey, they're either drinking quite a bit of whiskey that's very expensive, or they're going to have a tough time selling it. So it'll be interesting to see how that story unfolds. With that, I want to thank everyone for watching, and I'll see you next.